Hey everybody, it's David. Well, it is July of 2025. Time to look back and talk about those mid-year investment results. Way back in January, I posted a very detailed video about my portfolio design for this year. I will place a link to it down below. But today is about discussing how I've done year to date. So that is what we're going to do. In this video, I'm going to go over each one of my retirement investments and talk about how they've done year to date. And then I'm going to talk a little bit at the end about how this year has impacted me as far as plans moving forward. Am I going to make any changes for that second half of the year? What am I thinking? Well, stick around the end and we'll talk about it. Are you ready? Hey, let's do it. Oh, and quick disclaimer. I am not a financial advisor. This video is not financial advice. It's just me being transparent to share with you my investments. Do your own research, make your own choices. Hey everybody, it's David here at David in Progress. We talk about three things: achieving financial independence, retiring early, and living your best life now. Hey, if you're new to this channel, I'm someone that retired at 56 in December of 2023. I'm 58 now, and I'm living off this portfolio, working my way to continue that wonderful life of early retirement and financial independence. It's so awesome. So if this is content that you would be interested in, hey, I'd love for you to give me a subscribe, leave a thumbs up. Either way, I'm glad that you dropped by. First of all, let's hop into the old time machine and go back to April. Oh, way back in April of this year. Right before recording this video, I went online and I watched my own video from back then. And it is amazing to think about the angst I was feeling after that first quarter, much like maybe you did. Believe it or not, we had one of the weakest first quarters in history. It was the largest drop since 2022 in that first quarter. Man, how have things changed since then? Things have been doing great. It is a lesson. It is why it is so important to not take moments of time and panic in what is happening. Also, don't take moments in time and just have euphoria that, hey, it's going to keep being that way. Recency bias is an actual thing. That is one reason I look at my stuff quarterly and then I make changes biannually, typically in July, and I'll make changes in January. That is the commitment I made to myself at the beginning of this early retirement journey. And as hard as it is, I'm working really hard to stick with them. Let's take a moment before we get into the results to talk about my general investment philosophy. When you are accruing wealth, when you're in that stage where you're working your way towards financial independence, you're seeking maximum growth. You get really excited when things crash. Those are the great times because you are dollar cost averaging, you are buying low, and then things are going to go up high. As a matter of fact, I was always excited during the crashes. I kept some money set aside to plug in, or I make sure my 401k was maxed out, all those kinds of things. You're excited when things crash. Well, when you transition over into retirement, you don't want to feel those crashes. They are going to happen. They are inevitable. But what you want to do is have your portfolio designed in a way that the ride is smooth. So back in January, again, I got my video down in the description describing it. I moved into a more conservative portfolio where I added bond funds. And I balanced things out a little bit so that when the crash comes, it would be not quite as painful. Although mentally, yes, that April, that first quarter was still painful. So my basic philosophy is I do no individual stocks. I'm only doing low-cost index funds, and I'm keeping things really simple. I want as few funds as possible. I actually think I have a little bit too many. Well, all right, let's look at those results. I've got some paper here. I'm not going to make you look at the paper. I'll pop it up here on the screen so that you can see. My core fund is this one, FXAIX. Represents 52.3% of my total account. Back in April, this thing was down negative 4.28%. Well, look at July. It is now up 6.2%. That is a great recovery. And one thing we want to do as we look at each of these is look across this top line right here where it says performance. And you can see the performance on this particular fund, 1 year is 15.15% positive. The 3 year is 19.7%, and the 5 year 16.63%. When you are looking at your funds to choose, the long-term results are what is most important. Second thing is also look at the cost. You can see this one is a really low cost fund at 0.015% cost. Very, very reasonable. So I've got those great returns, and then I also have that low cost. This is why this fund is the one I have chosen to be my core mutual fund in my retirement account. Let's look at this next fund. This is my Fidelity Blue Chip Growth Fund. It's one that I'm actually gradually drawing down from because it is my highest expense fund there at 0.47%. The reason I am still hanging on to this thing is that historically it has provided me terrific growth. However, if I go back in that time machine in April, this fund was down 13.06%. So that was really painful. I was very thankful back in April that back in January, I reduced my position into this fund. Has it made a comeback? Well, yeah, look at that. It is now up 4.18%, and you can see across the line of its results for the 1 year, 3 year, 5 years, and so forth. But for me, now in this wealth preservation phase, this is a fund that, despite its historically giving me just fantastic returns, that volatility is just something that psychologically I just don't want anymore. So that is the reason that I have been reducing my position in this fund and why I only have 4.54% of my total retirement savings in this fund. Next, we're looking at FZIPX. This is a small cap fund, something that I added in January to try and increase my diversity. I was watching a lot of videos from Paul Merriman, and there's this great one that maybe I'll find and put down in the link below where Paul Merriam and J.O. Collins are debating whether you even need a fund like this. I decided to experiment with it back in January and place a small amount in it. This fund in April was down 6.28%. And just look at it here in July. Now it is up 2.94%. If you look down at the cost, this is a zero cost fund. Fidelity has some funds that actually have no cost. One of the things I really like about it, so that's the reason I chose this fund. Look at the 1 year results. 10.77%, the 3 years at 11.85%, and then you can look on down the line. Again, this fund is a little bit of an experiment for me. It's one reason I have such a small percentage of my retirement savings. Pretty low results there at that 2.94% relative back to my core account, but I'm going for a little more diversity in my retirement portfolio. And for now, I'm going to stick with the small cap and keep it in my portfolio. So that's basically it for my equity funds. Yeah, 3 core funds that I use for my equities. Now let's move on and look how I did with my bond funds. Prior to my early retirement, I had 0 bond funds, something not recommended at all by most people. But when I got into January, I decided to add some for that smoother ride, and this is my core bond index fund. It is FXNAX, a Fidelity US Bond Index Fund, a really low cost at 0.025%. Back in April, this fund was doing its job. Now, remember that core fund was down 4.28%. Well, this fund back in April was up 2.76%. So that inverse relationship, which has not happened in the last couple of years, but has happened this year, that when the stock market was down, the bond funds were going up. That happened back in first quarter. These funds are not in your account to be gains. These are not part of your wealth accumulation. They're part of that wealth preservation. And year to date, this fund is up 3.98%. If you go across and see the various lines there on the multi-year performance, you can see this fund is not going to give you a whole lot of return. It is for safety purposes, and it represents 18.31% of my portfolio. The next bond fund is VIPX, which is the Vanguard Institutional Total Bond Market Index Trust. Well, that's a long name. Well, these Vanguard funds like this within a Fidelity account, this is within my core 401k. It's an institutional account, meaning that it is something that only someone with the 401k would be able to put money in it. Very common when it comes to 401ks. For me, I am strictly using this fund to park money that I'm going to withdraw when I do those Rule of 55 withdrawals. Wait, what is Rule of 55? Well, hey, link down in the description to see how I use that to retire early. Anyway, you can see this one, when I was looking at it in April, its return was basically 3%, 3.01%. Market's going down, the bond fund is going up and staying stable. As of today, It is at 3.9%. So, hey, not a whole lot of growth, but it is doing its job. It is staying stable. The next fund is part of that bond family, and I'm trying to have a little bit of diversity and go back to the Paul Merriman thing. I added a little bit of short-term bonds, short-term bond index fund, and that is this one. It is FNSOX. Back in April, it was up just really around 2%. It was at 2.01%. And now as of July, it is up 3.47%. And this represents 3.4% of my total portfolio. So it is a small amount, but again, I'm going for a little bit added diversity here in this early retirement. I've been pretty happy with this fund. Lastly, here we are with cash. In my retirement savings, I have 9.28% held in cash. Felt really good about that back when the market was crashing. Looking at my results, you can tell that it is cash that is driving things down. Cash and bonds, of course, which, hey, that is what's supposed to happen in this wealth preservation stage. All right, drumroll, what is my year-to-date returns, January through the end of June? Well, here it is. It was 4.12%. Hey, not so bad. I wish it was more, but given what happened in that first quarter, I'm very thankful to see things green as of this time of the year. But you know what you really want to look at is a longer time. How did I do for the last 12 months? Look at that, 10.46%. Yeah, I will take 10% all day. Very happy to have that. Looking forward into the second half of the year, what am I going to do? Well, for one thing, it is time to take some money out, doing the Rule of 55. Going to be doing that in the next couple of weeks in order to finance the second half of my year. I only withdraw twice a year. At over 9%, that cash balance is really kind of gnawing at me. I got to remind myself how back in April, how good I felt about that and my 3-bucket strategy, the way that I have my account set up. You can see a video link to that down below. But that cash was good, but I am struggling whether or not to just put a little more of that back in the market. Love to hear from you. What do you think? Well, April taught me that my bond holdings and my cash holdings were really great. Maybe a little bit too much in those. When I do my sell in the next couple of weeks to finance that second half of the year, I am going to take it out of a combination of those buckets. I'm not going to be selling from the equities. Other than that, no major changes. You know, the key in this early retirement thing or in this retirement thing is to get a plan and commit yourself to stick to it. When the highs are there and the lows are there, don't panic or don't get too happy and make big changes. That's what I like about doing things just twice a year, like I'm doing now. All right, well, that's it. That is the mid-year financial review. Hey, I'd love to hear from you. How did you do this first half of the year? Were things up for you? Were they down? How did you feel back in April when those crashes were taking place? Did you make changes then? If you did, was it a good thing? Or are you now regretting it? Well, that's a wrap. It's been quite a first half to 2025. I'm looking forward to that second half. I just want to thank you for watching, especially if you made it all the way to the end. Thank you for those thumbs up. Thank you for those comments. And hey, thank you for being part of David in Progress.